The Chinese, the Japanese, the Europeans, the Australians, the UK. I mean, everybody wants a weaker dollar. One thing I do know is Januaries have this lovely habit of blowing everybody up before the true trend establishes. In GMI, I've been writing for 20 years, I've never made a trade in January because January always gives a conflicting signal. And so the signal now is, oh my God, the markets, rates, this is terrible. And usually what happens is it completely reverses sometime in Jan or Feb, and the market then sets its direction. So I never read into Januaries.
Raoul Pal begins by highlighting an uncanny resemblance between current global monetary conditions and those observed in previous cycles. By comparing the global money supply, the aggregate amount of money in circulation, over two different periods, he notes striking similarities in their patterns. These trends, alongside the performance of the NASDAQ and Bitcoin, suggest recurring behaviors in financial markets driven by liquidity shifts and macroeconomic forces. A key observation is that Bitcoin's price patterns are phasing similarly to past cycles. By matching historical data points, Pal identifies parallels that indicate potential market behaviors.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
This chart at the top is global M2 last time around versus this time around. And global M2 last time around, this time around, it's identical, which is kind of weird. Then we also have beneath it is the chart of the NASDAQ, and that's pretty much identical. So we have a repeat in the monetary conditions, global M2, because the dollar was strong, that's what's pulling back global M2. It also caused markets to readjust. When we look at Bitcoin, we can see the phasing's out, but when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up. And once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. It should drag the DXY, change rate expectations. Julian just put out a tweet this morning about all of that. So everything is here. Fed cuts may change because there's now like 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff, I don't know. So using the parallel of 2017, I think the bottom is in. I think it happened today. Now, the other outcome would be the outcome you've shown me. But my base case is that using the historical parallel, I think we probably put the low in. I mean, Bitcoin price action, was ugly today. Let's wait and see. Not that I'm not buying, not selling, not doing anything, but it's either your outcome, which is a sharper fall for longer, in which case it's fully mirroring the M2 drop, or it does what it did last time, which is it prices in the first part of the M2 drop and then dislocates, and it tends to dislocate the rest of the year because there's more speculative flows in the final year. Liquidity should come in. So the one thing I am looking at is it has been the canary in the coal mine for the bond market. The UK seems to have the worst liquidity of all of the major bond markets. And if I look at on Bloomberg, the gilt liquidity index, it is now continually trading higher than the Liz Truss, gilt intervention. So it cannot be escaping the central banks that inflation expectations are stable, and yet yields are exploding higher. And again, right in your wheelhouse, it is telling you, screaming at you, there is not enough liquidity. Now, and understand they're scared because they've just gone through that inflation episode and everybody's still angry about it and whatever. So they're reticent to do something. So they're trying to hold on as long as possible before injecting liquidity. But politics will trump all, and US politics is the big daddy of it all. And the US needs to add liquidity because they're about to have the debt ceiling shut down, and they're going to and Trump has got to show markets going up, people are happy, all of that, and we know how to do that. It's simple. Just jam the pedal on the accelerator with liquidity and everybody's a winner. The other thing that a low ISM indicates to you is that household earnings and corporate earnings outside of the tech are somewhat stagnant still, right? So the feedback loop we haven't had yet. Even though the economy has been growing at decent clip, the actual broadening out of economic growth with recycled earnings and profits hasn't really happened. So it's a very late cycle in that respect. And the moment it does, it means that the structure of markets changes, small caps start doing better, alt season happens in crypto, it's all the same risk curve. Junk outperforms, all of this stuff starts happening the moment that happens. And we're still not there because of Fed rates, I think. The Chinese, the Japanese, the Europeans, the Australians, the UK, everybody wants a weaker dollar. One thing I do know is Januaries have this lovely habit of blowing everybody up before the true trend establishes. In GMI, I've been writing for 20 years, I've never made a trade in January because January always gives a conflicting signal. And so the signal now is, oh my God, the markets, rates, this is terrible. And usually what happens is it completely reverses sometime in Jan or Feb, and the market then sets its direction. So I never read into Januaries.
Pal remains optimistic about the long-term trajectory of markets. He argues that the current dynamics are setting the stage for a renewed cycle of growth and investment opportunities, particularly in risk assets like Bitcoin and speculative equities. Investors should remain vigilant, balancing caution with an eye for opportunities that arise from these macroeconomic shifts.
The dollar is driven by the fears over the new Trump administration and what tariffs mean. And that has pushed the dollar higher and rates higher. And this whole thing is the exact same setup, and you and I have talked about this, of the dollar and rates in 2016-17. With the same set of Trump outcomes and tariffs and the same policies, it did the same thing. The first thing Trump did when he got into office was say, I want a weaker dollar. And he's already said rates are too high. So they're not stupid. They also know that they've got debt to roll, that they also have trade negotiations to do. So my view is they will use the stronger dollar as a carrot and a stick, which is China, you're going to have to devalue your currency unless you play ball with us. But if you do play ball with us, we will inject liquidity into the dollar system. We will lower the dollar. We will jawbone it lower. And you can then stimulate your economy, because the Chinese cannot stimulate right now without risking a breaking of the yuan peg, which they don't want. So I think it's all part of the Trump trade negotiations. And we know that the teams have already been kind of speaking to the Chinese and the Europeans and everybody else. When you go back to Besant, who I know decently well, Scott has made it clear that the dollar is too strong and that he would want a weaker dollar. Lower oil, weaker dollar. They want easy financial conditions because they want to win the midterms. And that's a big thing. Then there's the new guy who's coming in. I can't remember, Felix from Blockworks interviewed him. Can't remember his name, the Economic Council guy. Stephen
Buran.
Yeah. Very interesting interview. And Stephen spent half the interview talking about, at some point, we're going to need a Plaza Accord if this continues, but we are going to have to get the dollar lower. Now, I don't think the Plaza Accord idea is this time around. I think it's probably closer to 2030 that people are just going to go, we can't deal with this dollar. Now, the dollar is structurally strong because the world is 50% in debt in dollars and there's a shortage of dollars. The moment the US takes liquidity out of the system, it's a game of musical chairs and it drives the dollar higher. So, people will bid up for dollars. So that's where we are. We've also, as you talk about a lot, we are waiting for the injection of liquidity that comes as the reverse repo redrains back to zero, then probably the end of QT, and then the draining of the TGA. Also in the Fed minutes, sorry, I'm trying to get across a lot here. Also in the Fed minutes, the previous minutes, they had talked about that they're not keen to rebuild the TGA immediately afterwards and have a tightening of financial conditions. So what does that mean? I mean, either there's another way around it, or as you possibly suggested, it could mean QE, which sounds ridiculous now, but who knows? The other thing that this financial conditions is doing is pushing down forward growth expectations. And so it starts to make you think Q1, Q2 might be weaker, and that gives the Fed more cover also to cut rates. So lots in that. I don't think liquidity affects inflation, really. I think they're driven by different things. One is debasement, one is the price of goods and services, and I don't think they're necessarily driven by the same things. A lot of this is also the year-on-year base effect. So, and the central banks know that as well, which is why they've been saying, the Europeans, the US, everybody's kind of like, it's going to be a bit wiggly for a while. But overall, we still haven't fully deflated all the housing stuff that's back-end loaded in CPI. So it's going to be heavier than people expect. Also, we're expecting to see economic growth slow down somewhat. The SESI kind of says we're going to get weaker data, but anything now, like the high yields now, plays into inflation in 6 months' time, 12 months' time, i.e. lower. So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic, and this lagging of housing and rates being so high for so long. It doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time.
Pal also highlights the structural factors supporting the dollar's strength, such as global debt in dollars and liquidity shortages. He suggests that the resolution of these imbalances will require significant interventions, possibly on a scale akin to the Plaza Accord of the 1980s. However, he believes such measures are unlikely before 2030. As the discussion unfolds, Pal emphasizes the interplay between bond yields, inflation, and growth expectations. High yields are suppressing forward growth estimates, creating a backdrop that could give the Federal Reserve more room to cut rates in the coming quarters. Pal predicts weaker economic data in the first half of the year, further bolstering the case for a shift in monetary policy.